Financial freedom rarely begins with capital. It begins with the way a person thinks, interprets reality, and makes decisions. The common fantasy is that a pile of money leads to wealth, but history shows the opposite. Many people who start with resources lose them quickly, while others who start with nothing learn to build something durable and valuable. The first real asset is not money, it is the mind. A disciplined mind can turn small opportunities into sustainable income, while an undisciplined mind can turn large opportunities into bankruptcy. When you have zero financial capital, you are forced to build intellectual capital, mental models for how the world works, how people behave, how markets price value, and how compounding rewards patience. This is a better starting point than quick money because it cannot be taken away, taxed, inflated, or stolen. Mental models are essentially the operating system behind smart decisions. They allow you to separate signal from noise, temporary luck from durable skill, and real opportunity from seductive traps. In a world flooded with distractions and illusions of fast success, the ability to think clearly becomes a competitive advantage all on its own. Clear thinking prevents you from wasting years chasing things that don't matter, buying liabilities disguised as assets, or following trends that enrich everyone except you. When your goal is long-term financial independence, clarity is worth more than enthusiasm. The process of building mental capital is slow, and that is exactly why it compounds. You gain insight from reading, from observing, from failing intelligently, and from asking questions others overlook. You start to understand that wealth is built over decades, not weekends. You recognize that delayed gratification is not a sacrifice, but a strategy. You learn to see money not as something to impress strangers, but as a tool for autonomy, optionality, and protection against uncertainty. This mental framework eventually becomes your blueprint for financial freedom long before money arrives. Starting from zero forces you to confront reality without illusion. You can't rely on inherited assets or inherited status. You must rely on logic, discipline, and curiosity. Paradoxically, this can be an advantage. People who begin with too much comfort rarely develop sharp thinking because mistakes are cushioned and impulses are indulged. But when you have no excess, every decision matters, so you learn to value accuracy over impulse, frugality over vanity, and long-term positioning over short-term gratification. Financial freedom is ultimately the reward for a series of rational decisions made over many years, not for a single lucky break. Money is merely a downstream effect. If the mind is chaotic, money will evaporate. If the mind is structured, money will accumulate. The difference between the two is not income, it is judgment. Judgment is what allows someone with no capital to spot hidden opportunity, negotiate value, avoid destructive risk, and capture compounding gains. That is why the journey from zero capital begins not with tools or contacts or funding, but with the quiet work of shaping the mind into something capable of handling freedom once it arrives. When someone has no money, they often think they have nothing to invest, but that assumption is wrong. The first currency available to every person, regardless of background or income, is time. Time is more fundamental than money because it is the raw material from which all future capital is produced. Money can be lost and regained. Time, once spent, never returns. When financial capital is scarce, the intelligent allocation of time becomes the differentiator that separates stagnation from progress. The people who reach financial independence are rarely those who were born with advantages. They are usually the ones who treated time as capital long before they treated money as capital. The modern world is full of distractions engineered to hijack attention, and attention is the visible expression of time. Most individuals unconsciously trade their hours for nothing, consuming entertainment that doesn't educate them, scrolling for stimulation instead of studying for advancement, and seeking comfort instead of capability. When you start from zero, you cannot afford to allocate time casually. You must allocate it like a venture capitalist allocates funds toward learning that compounds, building that scales, and experiments that reveal opportunity. Time spent learning a useful skill is not an expense, it is an investment with an unknown but potentially enormous return. Knowledge compounds in a way that money does not. A dollar invested can produce a predictable return. A year spent mastering skills like communication, technology, or critical thinking can produce opportunities with no predictable upper boundary. In a world where markets reward scarcity, specialized knowledge bought with time becomes the rarest asset of all. The self-taught programmer, the disciplined analyst, the skilled communicator, the rational negotiator, these people eventually attract income not because they sought money, but because they used time to make themselves valuable. Another benefit of using time as currency is that it builds resilience. When you learn how to create value without relying on capital, you develop confidence that no recession, no crisis, and no employer can fully take away. Dependency decreases and optionality increases. You are not trapped into selling your time to the lowest bidder because you spent earlier years making that time more valuable through skill acquisition. Over enough cycles, the world pays a premium for people who invested their hours wisely. Treating time as currency also instills patience, and patience is one of the rarest traits in a society structured around instant gratification. Everyone wants the reward, few want the timeline that produces it. But financial freedom is the compound result of years of quiet effort. When you start from zero, patience is not a luxury, it is a necessity. Small habits like reading instead of scrolling, practicing instead of fantasizing, and learning instead of complaining seem trivial in the moment, yet they accumulate into enormous advantages over longer horizons. Eventually, time converts into competence, competence converts into income, and income converts into capital. Capital then compounds, but a lie after time has done the initial heavy lifting. This is why the path from zero to freedom never begins with money. It begins with how a person spends their hours when no one is watching and no one is paying. In a world obsessed with talent, people forget how powerful the combination of ordinary skills can be. Most financial progress does not come from being extraordinary at a single thing. It comes from being reasonably good at several things that, when combined, make you economically rare. This is skill stacking, an approach that allows someone starting with zero capital to create leverage without needing elite credentials or inherited opportunity. The market pays for value, and value often emerges at intersections: communication plus technology, creativity plus psychology, analysis plus execution. Alone, each skill is common. Together, they become a competitive advantage. Skill stacking also changes the nature of effort. Instead of trying to outcompete the best in the world at one thing, you compete in markets where very few people bothered to develop a decent level of competence. Becoming the top 10% in multiple useful skills is far easier than becoming the top 1% in a single domain, yet the market often rewards the former just as well or better. For someone starting with no money, this approach is logical because it is built on time and intention rather than financial capital. Skills cannot be confiscated, inflated away, or lost in a market crash. They are assets that follow you wherever you go. Communication is a prime example. The ability to articulate ideas clearly, speak persuasively, negotiate fairly, and write coherently multiplies the value of every other ill. A technically competent person with poor communication is easy to underpay and easy to replace. A moderately competent person with strong communication can lead, sell, persuade, and collaborate. Communication turns knowledge into influence and influence into economic mobility. It is not a talent, it is a skill learned through deliberate practice. Technology literacy is another layer. You do not need to be a world-class engineer to benefit from technology. You simply need to know how to use modern tools to save time, automate tasks, analyze data, and reach audiences. The person who combines basic coding, basic design, basic analysis, and basic communication can create value in ways that would have required entire departments in previous decades. The barriers have collapsed for those willing to learn. Yet, most people use technology for consumption instead of production. Critical thinking enhances the stack further. The ability to reason without emotional distortion, to evaluate incentives, to question assumptions, and to track consequences is rare. Most financial mistakes are not caused by lack of opportunity, but by lack of judgment. Judgment determines which doors to ignore and which to open. It prevents self-inflicted wounds, the most common cause of economic stagnation. The beauty of skill stacking is that it compounds. Each additional skill enhances the value of the ones you already have. A year of disciplined learning in 3 or 4 areas can make someone economically unique. Financial freedom is ultimately the byproduct of being useful in a market, and usefulness is not born from talent alone. It is built from stacked skills that produce results others find difficult to replicate. When you begin with zero capital, this stacking becomes your most rational wealth strategy. Progress rarely comes from giant leaps. It comes from small, intelligent actions compounded over long periods of time. This principle is misunderstood because humans tend to imagine success as a dramatic breakthrough, a bold risk, or a sudden stroke of luck. But the real engine of financial freedom is consistency. Small improvements made daily, even if they appear trivial in the moment, create exponential outcomes when measured across years. The remarkable thing about compounding is not how fast it works, but how quietly it works. It rewards the patient, the disciplined, and the rational, people who are willing to trade short-term dopamine for long-term independence. Most individuals sabotage their own progress by seeking novelty instead of repetition. They switch strategies, abandon habits, and chase new opportunities before the benefits of the previous ones have had time to compound. They underestimate how powerful a modest improvement can become when repeated thousands of times. Reading 10 pages a day appears insignificant, but over 10 years it becomes a library of mental models. Saving a small percentage of income seems inconsequential, but over decades with compounding, it becomes a protective buffer and then real capital. A business that improves efficiency by 1% each week becomes unrecognizable in a year. The difference between mediocrity and mastery is often just time plus consistency. Compounding also applies to behavior. Good habits compound just like capital, and so do bad habits. A small, consistent act of discipline, waking up at the same time, studying an hour a day, writing every morning, strengthens the foundation on which financial life is built. Conversely, recurring indulgences, impulsive spending, chronic procrastination, emotional decision-making, erode that foundation and create future debt, both financial and psychological. People underestimate how costly repeated stupidity can be, just as they underestimate how valuable repeated competence can become. What makes compounding difficult is that the benefits are invisible in the early stages. There is no applause for progress measured in millimeters. In fact, the initial phase often feels like stagnation, which is why so few persist. The human brain is wired for linear rewards, not exponential ones, so people quit at the very moment their efforts begin to accumulate. But compounding punishes impatience and rewards endurance. Once the curve tilts, the gains seem effortless and inevitable, even though they were neither. Financial freedom is a compounding phenomenon. Wealth grows faster after the first small pool of capital exists, but that pool is created through habits, learning, saving, producing, and improving. The same is true for careers and businesses. A career becomes valuable after years of skills and connections compound. A business becomes resilient after years of customer trust and operational efficiency compound. There are no shortcuts to these effects, only accelerators for those who persist. When starting from zero, compounding is the greatest ally because it does not require privilege or wealth or perfect timing. It requires only the discipline to begin small, the rationality to continue, and the patience to let time do its work. Our long enough horizons, consistency becomes a superpower that transforms ordinary inputs into extraordinary outcomes. The fastest way to move toward financial freedom is often to stop doing the things that predictably lead to financial ruin. Most people assume wealth comes from discovering brilliant strategies, but it is more often built by avoiding dumb mistakes. Eliminating stupidity is simpler than chasing genius. Defensive thinking protects fragile progress from being erased, and this protection compounds over time. Bad decisions carry more weight than good ones because they can reset progress to zero. Avoiding debt traps, impulsive consumption, speculative gambling, and the belief in effortless riches is not glamorous, but it is powerful. Modern society has normalized financial self-sabotage. Credit cards turn consumption into obligation. Loans turn impatience into long-term vulnerability. Subscription culture transforms small recurring expenses into significant annual drain. Status-driven buying encourages people to purchase symbols of wealth instead of the behaviors that create wealth. Many individuals would already be closer to financial independence if they simply stopped digging financial holes. The first rule of compounding is to avoid interruption, and nothing interrupts compounding more brutally than avoidable stupidity. Defensive behavior is rooted in awareness. You must understand how incentives work. Companies are incentivized to sell convenience and appearances. Governments are incentivized to stimulate consumption. Social media is incentivized to display lifestyles that provoke envy. If you don't understand these incentives, you become the product and not the beneficiary. Financial freedom requires the humility to question, the discipline to say no, and the clarity to see through illusions designed to separate people from their money. Impulse is another enemy of financial progress. Impulsive decisions feel harmless in the moment, but their cumulative effect is destructive. Impulse purchases delay saving. Impulsive investments magnify risk. Impulsive career changes destroy momentum. Impulsive commitments consume time. Rational restraint is not about denial. It is about alignment. You choose what matters and decline what doesn't. You build a filter for decisions. Does this move me closer to autonomy or further away? Most people never ask that question, and so they drift. Scams thrive on impatience. The promise of quick money seduces those unwilling to engage in compounding. But quick money schemes are predictable traps because they exploit human tendencies: greed, envy, urgency, and fear of missing out. The people who maintain long-term progress are those who resist shortcuts. They recognize that the world does not reward fantasy, it rewards value. They understand that if a strategy worked reliably, it would not be advertised to strangers online. Defensive skepticism is not cynicism. It is protection against predictable loss. Avoiding stupidity also applies to psychological errors. Emotional decision-making is expensive. Fear causes people to sell at the wrong time. Excitement causes them to buy at the wrong price. Ego causes them to take risks they cannot afford. The ability to detach from emotion and reason calmly during stress is a competitive advantage that costs nothing to acquire but pays endlessly once developed. Over time, eliminating stupidity creates space for competence to flourish. Financial freedom is less about extraordinary intelligence and more about consistent avoidance of predictable mistakes. Progress accelerates when you stop sabotaging yourself, and the journey becomes less about heroic wins and more about quietly preventing unnecessary losses. The path from zero capital to financial freedom becomes far clearer when you recognize that money is a byproduct, not the starting point. Wealth flows toward individuals and businesses that consistently create value for others. People pay for solutions to their problems, for time saved, for convenience gained, for risk reduced, for clarity provided, or for experiences that improve life. When you begin with no capital, the most ethical and realistic shortcut is to focus on serving needs rather than chasing money directly. Money follows usefulness. If no one benefits from what you offer, no financial strategy will rescue you. Value creation also scales in ways that labor alone cannot. Working harder might increase income marginally, but solving a problem that many people share can create wealth exponentially. This is why entrepreneurs who begin with nothing can outperform those with resources. They design solutions, not excuses. They ask better questions, such as, what frustrates people? What wastes their time? What do they fear? What do they desire? What do they avoid? The answers to such questions reveal the raw materials of opportunity. Every innovation, product, or service in the market began as someone's attempt to solve a problem. Another critical aspect of value creation is alignment. The highest leverage work occurs when personal skills, market demand, and distribution align. A person may be skilled, but if the skill is not scarce or valued, the market will ignore it. Conversely, a skill that seems ordinary becomes valuable when applied in a context where demand is high and supply is low. When starting without capital, you must identify where the market is inefficient, underserved, or inefficiently served. There is always inefficiency somewhere. The world never runs out of problems. Value also compounds reputationally. Doing work that matters, delivering reliably, and behaving ethically creates trust. And trust is a form of capital that requires no money to begin accumulating. Trust reduces friction. Trust brings referrals. Trust lowers marketing costs, increases pricing power, and expands optionality. People often underestimate how powerful reputation is because it builds quietly over years and then pays suddenly. Many individuals remain stuck simply because they have not yet built a track record that allows others to depend on them. The pursuit of value creation inherently filters out get-rich-quick fantasies. It demands learning, experimentation, curiosity, and patience. It exposes you to feedback, which is uncomfortable but essential because it reveals what the market actually wants rather than what you wish it wanted. The market does not reward desire, it rewards contribution. People who internalize this truth gain control over their financial trajectory, not because they are lucky, but because they understand the mechanics of how wealth emerges. Financial freedom eventually arrives as a consequence. Skills produce value, value produces income, income becomes capital, and capital, when intelligently deployed, compounds. The starting point is never money. The starting point is usefulness. From zero capital, the most rational strategy is not to ask, how do I make money? But rather, how do I create something that someone else considers worth paying for? That question is the bridge between poverty and autonomy. Financial freedom is not a trick, a shortcut, or a lucky event. It is a process, slow, rational, and grounded in behavior rather than circumstance. Starting from zero does not mean starting with nothing. You begin with the two assets that matter most, your mind and your time. When you invest those wisely, money eventually follows as a predictable downstream effect. You learn to think clearly, to allocate hours with intention, to stack skills that make you economically rare, to embrace compounding even when the results are invisible, to avoid errors that erase progress, and to create value for others in ways that scale. None of these steps require wealth to begin. They only require discipline and patience. The world will always tempt you with speed, fast success, fast money, fast recognition. But financial independence belongs to those who choose trajectory over theatrics. It belongs to the individuals who quietly compound knowledge while others chase noise, who avoid traps while others celebrate impulse, who create value while others seek shortcuts. The path from zero capital to freedom is accessible but not effortless. It rewards judgment, not luck, character, not envy, contribution, not fantasy. If there is one universal truth in this journey, it is that the long term eventually arrives. When it does, it pays in proportion to the decisions made while no one was watching. Freedom is not purchased. Freedom is compounded, and the compounding begins the moment you choose to use what you already have instead of waiting for what you do not.